Hey, hey. The too long didn't read. Um, what do I buy? Oh boy. Yo, what's up? Wait for everybody to jump in this. Give it a few moments. But all right. Let's see what we got. In markets right now, the main story has been the main story for at least the past 2, 3 days. If you follow me on Instagram, at least you know that bit of what's going on, and it's really um, the continuation of bombings and what we have going on in Iran and the Trump administration and their decisions that they've made, and now as well the ramifications of those decisions have been expressed through oil prices being much higher. Um, for the mere fact that Iran, is a major producer of oil at this point in age. I wouldn't quite say buying oil now is a good buy. Um, I don't think so, at least at the moment, for the mere fact that exactly, gas was just 260 and now it's 320 in certain regions. Plus, national average. Is there a better buy than gold? Um, yeah, there's always a better buy. You know what I mean? Like the market has infinite opportunities. There's almost a better buy in like I view a lot of things in the markets on a spectrum. Um, you could be right. You could be just enough right. You can also be just enough wrong. So with that being said, like you can I mean I do think gold is a good buy in general right now. Um I'm just not sure if I'm just not sure if gold is going to react the way that we've historically expected it to. Um, that question really depends on, and the question being asked on in this case is, how long do I think that the war will affect stock prices? It depends on how long the war is. Because if I'll tell you this right now, if Trump comes out tomorrow morning and is like, "Yeah, we're done. We're like, I'm over it. I'm tired of like dealing with them or whatever, whatever. We don't want to do this anymore, or we're done. We're not sending any more missiles or any more troops over there to help out in that scenario." I promise you, it will be a slow turnaround in the case of like um in the case of like us getting back to all-time highs and da 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 da. But it will be a violent U-turn, just like the U-turn we saw with the with tariffs. We had tariff, yeah, we're gonna tariff a lot of people. And then Deliberation Day, we tariff everybody 100% plus, right? And then we drop limit down, damn, basically like 2 days in a row, down, down. Then what? This is the greatest economy in the world, and I will do everything in my power to make sure that the stock market, blah, 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 limit up 14% on an index level. What? Like, that's just it's a headline driven economy or market right now, not economy really per se, but it's a headline driven market right now. Whatever is the hottest headline is what is moving the market. And right now, the hottest headline is they're dropping bombs over there, and they're a major piece in the movement of oil and the global supply chain of oil. So, what happens when um, elastic um, products and services have um, deal with supply shocks, right? The price shows that it's elastic. Um, do you happen to have a rubber band? May I have it, please? Um, is it better to do nothing here, or do you think where is best opportunities? I think right now, if you're not already positioned, it is. Thanks. It is best to probably do nothing here if you're not already positioned, right? Like, um, I think, yeah, yeah, you could definitely grab some shares of some names that are at a discounted level. Only exactly good companies only. I'm I would say also like it really depends on your horizon, right? Like this that's kind of so hard to like talk about markets without understanding that person's risk tolerance, understanding that person's time horizon on that money, or like or even that person's like capability to be within the market and understand also like when to exit, or even like when certain things like affect them more. You know what I mean? Because as a person like myself who's always watching the markets in some capacity, right? I have an internal clock or gauge as to like, okay, I should probably start trimming here. Okay, maybe I should lean a bit more into the position here. It's a really good buy here. Like, and I'm always gauging that question in my head. It's always, do I trim here? Do I add here? Do I sit still? Do I trim here? Do I add here? Do I sit still? Right? It's like it's almost like an assembly, like a fireplace, right? Like I have some ideas, right? I made a few reels about what was going on, and I'm like, okay, like they're dropping bombs in an area where oil is needed, and like historically speaking, these things usually work out. I was really tentative at first because oil wasn't moving as I thought it would off the news in the first place. So I was kind of like lightly dipping my toe into the whole narrative of what usually would plan out in these scenarios, right? The playbook is simple in these scenarios. Long gold, long dollar, reduce risk on assets, exposure to risk on assets, right? Um, and and maybe focus on a little bit more commodities, right? Especially precious metal commodities, because they're safe haven assets. And usually when people de-risk risk on assets, like selling Nasdaq or Nvidia or whatever growth asset, then they usually rotate that capital. Capital doesn't always go back to cash and just sit as cash. A lot of times it just goes from one bucket to another bucket for the time being until the next bucket becomes more attractive, right? Then that's also like why I'm super like aware of pendulum economics, and I'm not even. I believe I coined the term. I don't know if that's the case or not. Maybe I'll do some research on that to see if that's the case, and hopefully I can own that term, and it could be Nedrix, quote unquote, and maybe I'll get a Nobel for it. But 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 essentially, right? Like once those risk on assets, those the selling down of risk on assets usually leads to raising a cash balance, putting a portion into maybe some bonds because people are believing that the economy 5 years from now, if we get the 5 year note, 10 years from now, if we get the 10 year note, would effectively be better than it is currently in the current circumstances of potential war, right? And then and that's usually the playbook. But because metals have had such a speculative run over the past year change, where things have gotten a bit frothy up top, it hasn't had as much room like it would generally would to run in the first place, right? So it's kind of changed the dynamic. So to go back to the fire, or like stoking the fire in a way, right? It's like all these data points are continuously coming into my head, into my understanding, into like whether that's reading a Deutsche Bank report, whether that's reading JP Morgan, whether it's checking CPI, whatever it is, right? And how you place that data point is also like how you place the firewood on the fire, right? Maybe you have a little clinger stick that can just come through and grab it, and then you can gently place the data point on the fire, right? And if you do that, then maybe some pieces underneath it break away because that wood is now a bit burnt down, and it's not so sturdy as it was, but the fire will continue to blaze, right? Now, if you come out too aggressive, if that data point comes in too aggressive on the fire, you'll see, maybe the structure of the fire that when you initially started it, it will start to fall apart. You see sparks fly everywhere because now this new piece of wood has shown itself as a part of this new ecosystem of what is a fire in the first place, right? And because of that, it those are the types of things that create these nth order effects that spill over into other things, right? So one of them being obviously one direct the literal event that occurs in this case is oil disruption. We've seen it. And if I show you some of my data points I've shared with the Integral Vote, if you're not a part of the Integral Vote, I'll put the link in the description. Feel free to join the Integral Vote. It's really where I place a ton of information continuously, and for you all to be able to, have at your disposal, so that you guys can, hopefully it aids you in helping some of your decisions as you are a part of the market or plan to participate in the markets. One sec, sorry. But I just put the link in the chat as well as in the description for you all if you guys want to join. Cool. That's there. Cool. Yeah. Right. So, like this, a lot of things in the market come back to cause and effect, right? The only reason why oil is over $100 an hour, $100 a barrel right now is because of what's happening, the supply shock, right? So in economics, there's inelastic things and elastic things, right? Whether it's supply and demand. So if you go back to basic supply and demand, it's essentially this. Um, Apple can only make a certain amount of AirPods, and there's only a certain amount of people that like AirPods, that have enough money to afford AirPods, that have access to even purchase AirPods. Um, and because of that, the demand, in my opinion, on AirPods would probably be more inelastic, right? Like there's already a rather set group of individuals that can do that, or that can own this product, and they either already own them, or they are looking to purchase new ones because maybe the ones they have now are broken or something, right? And then on the other side, this supply. Maybe Apple is able to create better supply chain, um, maybe even create other products, right? And certain things can change, right? So these AirPods, I think, are like $200 a pop, basically. And now, if they were to change price to now being a $70 AirPod or $50 AirPods, right? That would affect the supply of them. Why? Because the demand of them would dramatically increase. Because now it's not a $200 product that only a certain demographic of individuals can afford. Now it's a $50 product where it opens up the case for more and more people to be able to afford this, right? So when you're thinking about markets, or when you're thinking about literally anything, you have to try to think about what is elastic and what is inelastic. Like what doesn't really change that much, right? And in a world where we still use, for the most part, ICE engines in our vehicles, right? Even though EVs are very much a thing, everybody still needs gas, regardless. Today, tomorrow, next week, last month, probably next year. We still need gas. So the demand in that case is inelastic. But the supply can be very elastic. Very elastic. And we've seen that just in this past week. Why? Because we have seen it where, let's see, we have seen it where oil production in Iraq is now declined by 3 million barrels per day. Production has declined from 4.3 million barrels a day to just 1.3 million barrels per day, right? So at one point, we needed about 4.3 million barrels per day worth of oil, right? For you, me, our parents, anybody of this world and society, business owners, to use that oil to then, whether that's fuel jets so that they can fly from place to place when you want to travel, right? There's commerce involved in that travel as well. Maybe we want to travel from our home to the grocery store or our home to work. Maybe we want to just go on the boat and enjoy the day, right? It is very well proven that we need this. And we needed roughly 4.3 million barrels per day, at least from the Iraq oil production facilities, to be able to move us as a society, as a entire world. So now if one of our major producers cuts that back, what happens to the supply? The supply is very elastic in that case, where it shrinks now, and that shrinkage causes the increase in the price per barrel. And that's what we've seen today. We are seeing today price per barrel touching 110 as of market open, or as of futures open. And I'm not sure exactly where it is right now, but let's take a moment. Let's take a peek and see. $108, right? $108, y'all. Look at this. 107.95 a barrel right now. Um, you got risk on assets falling, right? Yeah, risk on assets falling, down. S&P down 180 basis points. Nasdaq down 200 basis points. The Russell 2000 almost down 400 basis points. The Dow almost down 200 basis points as well. That whole boasting and bragging about that Trump was just talking about the Dow being at 50,000. Yeah, we just gave back 4,000 of those points. We just gave back 4,000 of those points. And look, metals that would generally rise alongside this type of backdrop are down. Why? In what world? If you asked me of this a year ago to a year and a half ago, I would say this. I would say the dollar is up, which it is up 60 basis points, right? Because more and more cash has been put to the side. Risk on assets, S&P, NASDAQ, Russell, you know, Dow, all down. I would have not said that metals are down. Why are metals down 1.4? The silver down 2.7. Copper, platinum, all while oil and crude are up double-digit percentage points, right? That's not what I would have said. At least this is weird. This is where weird things are happening, in my opinion. Right? It's a bit weird to me, and it's because these metals have recently acted like risk on assets. The individuals and the holders of these metals are, I would say, at least for the time being, a bit more speculative than they are institutional and and more sound in their investment decisions per se, right? Um, and that's clearly what's here, right? Now, does it stay at this price point and level? That's the next question. So that's now the next backdrop that I'm starting to plan for. I'm starting to see it. Say, okay, got it. Boom, got it. Right? Like when I was on vacation and I was looking at this in my head and like trying to process this, I'm like, metals aren't really rallying. Oil is up, right? Like it was up. It was clearly up, right? From the first of March, where we seeing late February into early March. Like this was literally the kickoff. It was just on a slower side, in my opinion. I kind of expected it to have a beautiful run, which it did, and it has, right? Like look at this. After calling out basing right here in Q4 of last year and just being like, yo, oil's really cheap. Like how much cheaper can it really get? Like I'm seeing basically low twos. Like in my adult years, I've never seen $1.99 gap, I've never seen $1.99 a gallon. And in some ways, some shapes or form, you have to say to yourself, like, where's the extreme? Like we've reached somewhere close to the extreme of to like, this is beyond cheap. This is way cheaper than it's ever been historically for a long time. And now we found ourselves back near hyperinflation of 2022 post-COVID prices of oil, right? In the same way how oil went negative. Do you guys remember that? I don't know if you guys, maybe you weren't a part of markets or in markets at that moment, but in 2020, oil went negative for a brief moment where during the COVID lockdown, it plummeted from $18 a barrel to like negative $37 a barrel, right? And that was because, guess what? The exact inverse of what I'm talking about today. There was the demand that was once inelastic because we needed it so much became elastic. It became, we don't need gas because we're not going nowhere. I don't want to go outside and go get COVID. People had to pay people to take oil. Exactly. Right? And these are the types of dynamics that you have to just try to maybe put your eye on in life, just as a whole. And that's kind of a piece of what I'm also currently writing at the moment for my next Substack report. It's not. It's going to be a little bit less market exacting related. Like, oh, this is super interesting. I want to buy this, or this is super interesting. I want to short this. And going to be more zoomed out, philosophical kind of point of view as to how I approach markets and how I digest information, or just say, that's interesting. Let me look into that further, and those types of things, right? Because although I am very data driven, I'm also very observant. And that observant mindset has brought me pretty much to where I am right now, right? Like when I randomly think something, I just text a friend. Hey, have you noticed this? Hey, is this something that would like how would you feel about this? How does this, you know what I mean? And an example of that, actually, earlier or late last year, I texted a friend and I said, hey, what's oil like in your area? What's gas like? What's gas prices like in your area? Like, is it really cheap? Like, because as a New Yorker, I'm a bit oblivious to gas prices because I don't own a car here in New York, and I don't need a car, right? And for all intents and purposes, I don't need one. But like, it's as an investor, as somebody who's interested in markets, as somebody who's interested in the economy, it's important to kind of get a gauge, a welfare check on society. Like, hey, is gas prices good right now to you guys? Like, because some people may say yes, it's good. Some people may say no. I mean, like, it's okay, but like, I don't care about it, right? Or I don't pay too much attention to it, right? And I can compile all those data points in my head to say like, oh yeah, that's how that works. Okay, cool. Or another example, a coworker of mine said was like last month somewhere they went on a date with their husband, and something came about, and they were like just trying to get home, right? And in the city, at least in New York, it's a bit hard to get out of the city at certain times, as you'd imagine. And at this point, they're trying to call a car, and they're calling a car, and they couldn't get one. They couldn't get a taxi. The Ubers kept on canceling on them. It was just like so difficult. It was like, for whatever reason. And they're like, listen, I don't care. I just want an Uber. Like, I just want to get a car. And it's crazy to say that I guess Uber was struggling maybe with their algorithm at that moment, whatever the case may be. And their significant other was like, no, we're not paying $112 to get home. Like, no, we're going to figure something else out. And she kind of had the approach of, I don't care. I just want to get home. Right? So what does that tell me? That tells me that there's two demographics of people. People that are really, really willing to just say, fine, whatever, take me home. I need to go home now. I don't care the cost. I'm paying it. And there's a whole other demographic of people that are willing to take a 2-hour route home, buses, wait, move, this, that, just to not pay a $115 Uber. You know what I mean? And sometimes if you're so caught up in what you will do as an individual, what Nedrick will do, what I will do, it becomes unfathomable for you to understand what other people would do. And once you are in that state, you will become an absolute terrible investor. If you're unable to understand perspective and that understanding that even though you may approach your perspective with logic and reason or emotion or whatever the case may be as to how you approach it, your inability to look at somebody else's point of view or how they may perceive the scenario or the situation will make it 20 times harder for you to be an investor. Because at the end of the day, the markets are simply a culmination of people's decisions. And if you can't get out of your own and stepping over your own feet as to what it should do, it should do this, it should do that, why is it not doing that? You will just burn money, being in the wrong positions, timing things wrong, just sitting in it because you're being stubborn about it. I can't be wrong. This is what usually happens. You get what I'm saying? And that's how I feel about gold in this scenario. Gold should be up. We got central banks buying at a crazy clip, no signs of slowing down, right? Dollar debasement has been a question mark. But then the other part of it, though, is the dollar increase does weigh on on metals going up as well. So all that push, pull, this question mark, bum, bum. Then I go ahead and ask that same coworker, hey, quick question. So you couldn't get an Uber, you couldn't get a taxi in a traditional sense. Would you be willing to take a robo-taxi? What are your thoughts on that? If in this scenario, a Waymo pulled up and nobody was in the driver's seat and just said, hey, we're taking you home. And that 35-minute, 40-minute drive, are you going to accept that? Are you accepting that drive or no? And then they stop, look back at me, kind of cheese a little bit like, let me think about it. And like, nah, I'm not taking it. I'm not taking it. I was like, wow, interesting. So the person who's willing to spend $115 on an Uber for the 45-minute drive and their significant other isn't, and you're in a scenario where you can't really get a ride, you're drawing the line with a robo-taxi. Okay, cool. Good to know. And what does all that do? All that does is help me. Okay, sorry. 1 second. Sorry, guys. My apologies. Um, yeah, and so now I get to get a matrix in my head. I know that there's a demographic of people that don't want to pay mad bread to get home, that do want to pay, that are willing to pay whatever. I don't care if it's $300. What I'll get home. I just want to get home in comfort and in ease. And then people that are willing to also draw that line and say, "Nah, I'm not ready for the robo taxi though." So then I said, "Okay, well, hey, if the robo taxi was just driving you, in the city, maybe just a few blocks because you were a little, drunk on your feet, what you wear some heels maybe, right? And then you get to start to play the game as to, okay, under what circumstances would you feel comfortable in a robo taxi? And now I can take that information, continue to do research on my side, continue to do some, some world surveying, asking friends, asking social, whatever. And I get to gauge and say, okay, how accepting are we as a society of robotaxis? Is it really logical to say that Tesla can create so much in revenue because they're gonna release the robotaxis on Earth and people are gonna be able to take it in, right? I believe it's something that they call social arbitrage, where you're able to just gauge sentiment of individuals in society in a broader sense, and then you can try to incorporate that or put that within your model of like, is it really probable that Tesla's going to be really profitable off the robotaxis, or is it somebody else going to benefit off of it for real in a major way, or like what about it? You know, maybe certain people have feel a certain way about Elon and his leadership, and they say, yeah, you know what? I'll take a robotaxi, but I don't think I'll take a Elon robotaxi. Maybe I'll take a Google one because Larry and Sergey, I don't really even know them as a general person, and I trust Google more. They got my email. They got they got so many other things. They tell me that my favorite coffee shop's open on Memorial Day coming up. So I mean, I trust them. These are all things that you have to take into account, right? So back to what's currently happening in the backdrop. This is not really working well because the biggest bear of metals is that the dollar is increasing. And when the dollar is increasing, a lot of times the risk on assets tend to struggle, right? That the struggling of those risk on assets help aid in the increase of helps aid in the increase of the of the dollar value in the first place, right? So yeah, this is just something to think about. I guess that's the more like zoomed out, not direct talk about markets, but a perspective, a philosophy, whatever you want to call it, something you could think about, that I think is super, super important, for markets, going forward, and just how you're gauging them, as a whole, right? So that's that's one thing. Um, Let me show you something else. Boom. Um, so yeah, so as of right now, we've seen that's what currently the market backdrop is, right? And then now, to me, the main thing I'd be focused on is this backdrop continuing, right? Do we see more of this? Because Thursday, Friday, going into the weekend, I was seeing news headlines and confirmations that, oh, we went from sending missiles and doing a very hands-off but hands-on approach to now, uh, or from the administration saying this is not a war, rah rah. We don't have boots on the ground, this, that, and the other, as these like asterisks to defining the war. To now, where they're calling in people, like people are getting drafted up. People maybe that are already a part of the Air Force or the Naval Force or all these other, segments of the armed forces, to now being, oh, like you're in it, and you're also, you need to be called in, and then not only that, I'm calling you to the direct lines on top of that. So to me, that sounds like an escalation, right? It's where the pendulum continues to swing. So if we just have a moment, um, if we just have a moment to see what does a pendulum look like, um, I mean, I'm sure some of you guys have some point of view on this, right? But maybe this is just me and my, caring of math and math as a theory, and how it helps me understand things from a perspective. This is a pendulum, guys, right? Where effectively things swing from one extreme to another, right? And it's not always at the same pace, as you can see here. It's not always at the same length. And it also doesn't seem to swing at the same speed, right? Certain things can change the speed of the pendulum, the direction as well. As you can see, these like extreme points over here on this side tend to be like where the gauge is. Okay, that's the extreme. Okay, that's that, right? And the market tends to go in these cycles. It has a cyclical nature where it oscillates from one extreme to another, one extreme to another, and certain things can get in between to change the direction, change the speed, change the length of the pendulum and its ability to swing in these different directions. And the markets is really a focus on your ability to understand what can change those pendulum swings. Is it going to change the speed? Is it going to change the absolute direction? Is it going to change the length of what's going on? Um, that's weird. I got maybe it will show it because it's YouTube. I'm showing a YouTube video. Ain't that crazy? My fault. My fault. YouTube won't let me show a a video. Can you see it now? Okay, got it. That's weird. I was about to say like YouTube won't let me use like while streaming on YouTube won't let me use a YouTube video. Dang, that's crazy. All right, but that's the pendulum or a visualizer of one, right? And the gauging of these things, right? The gauging of, like I was saying, how new things, how a new log of wood on the fire can come into this space of the pendulum and change the direction of things, right? So, one being, oh, we're going into like Iran tensions, like they're kind of hot. I don't know what's going on. Like things are getting a little hot over there. Things like what's going on? And that's effectively what happened into like the end of February. So like February 20th into about the end, and then literally that that day of like I think what was the 27th or something into the weekend into the Monday, like basically the 1st of March, it was like, oh, Iran tensions. We had them. There were whispers of them prior, whispers of them more, and then the whispers got a little bit louder, and then they started on. Then they showed up on Bloomberg, and then it became a bit more louder, 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 louder. And then Monday we saw, or that weekend we saw, things get blown up on Twitter, and it was like, whoa, wait a second. It's not just tension anymore. It's not just, you know what I mean. It's not just we don't plan to de-escalate our nuclear program and we will converse about it, right? Because that's what it was. It was Iran at the table negotiating and saying, well, we'll think about it. We'll maybe not. And then they said that, and then they took that. We took it for what it was. And then they said, nope, we're actually not going to de-escalate our nuclear program. Oh, okay, now it's a problem. And then this is right. This is the pendulum, guys. Markets are good. Markets at all-time highs, right? There's volatility here. There's volatility here, but we're still at the highs. Like it ain't nothing crazy. Into now, oh, we're having problems. We're having some tension issues with Iran. We're having right. This pendulum's starting to swing. But and then on top of that, we get the confirmation of the VIX, right? This is why I pay so much attention to the VIX volatility. People hedging their bets. This is important. All these data points that I share on a day-to-day basis in the Integral Vault, right, are complete and absolute heads up for these type of events. To be ready for to be able to capitalize on these moments, to be aware of what's actually going on. I mentioned I don't like the fact that the VIX can't print a new low. All January, all year, we've been high, okay, low. High, low. Higher, higher, low. Okay, I mean, looks good, but like high, high or low. Okay, we got high again, but this ain't printed a newer low. That's good, but not lower than this one, right? We didn't reclaim new lows, and then we just flew through the top and flew through, and probably by tomorrow, VIX may be 35. You know what I mean? All while the VVIX, the volatility of the VIX, just continue to do the same and surmount upon each other, get over and over and over. All the correlation index showing the 1 month correlation continuing to be all in one. The more basically just showing that the market is correlating right now, and there's not much pockets of deviation, right? Pockets meaning specific sectors, specific equities, or even different businesses of equities that are able to make these differentiations. It seems as though that a lot of the market was all correlated. That's why these types of things and these gauges are important, because you're seeing the volatility, you're seeing the risk pan out right in front of our eyes. These are the things that are telling you, yo, check underneath the hood. Is everything good? What can break the system? What what would cause stress? Right? What is causing financial burden? What is potentially breaking what we have right now, right? And you have to ask yourself those questions continuously every single day in these markets. Okay, what's happened? What's going on right now? Is that good for us? Maybe it's not good for us. What was the expectation of that? Did we meet expectations? Are we just shy of expectations? Are we okay? That's the current backdrop, right? So that's what happened. It's happened so far, right? Assets, you know, we tried to make new highs. We obviously haven't been able to do such. Um, sure. Green water, green water. Yes, babe. Thank you. Um, right, and now that it's moved kind of like maybe not exactly to one extreme, it's definitely moved directly towards one, because look, we're already back at the highs of hyperinflation. You know, back when gas, if you were pumping premium, bro, you were pumping $5 a buck, $5 a gallon in Florida. We're near those highs, and that's the real scary part of it. So now I ask myself this: okay, if we continue down this path where we continuously, you know, destroy these structures, destroy the system, cut off the Strait of Hormuz, which is where logistically a lot of the oil is moved and shipped from different regions of the world, right? After removing that from it, now do we? Is this something that Sorry, one second. Why is it not here? Yeah, he's lit. Thank you. Cheers, y'all. Um, right. So now you have to ask yourself, like, what's the current backdrop, and what can change it, right? So the main in markets, try not to get, and it's so hard, but try not to get caught up in the chase, right? In this case being, oh, I want to go long oil right now. Bro, we're already like we're already up 40 points in like 2 weeks. If you're not already long oil, at this point you need to be figuring out something else. Find the next thing. Like find something, some like don't think the risk to reward is here anymore if you're not already there, right? And now what I'm thinking of is what can change this backdrop? What can change the backdrop? Maybe an aggressive tone from Trump and the administration saying, you know what? Cool. We did what we needed to do. Like I said, it's not a war. And, from now, I think Israel will be able to take it from here. And they can we've done what we need to do to step in to show that we can, fortify what's going on. And then now I can back up, step back a little bit and let them handle the rest of it going forward. And something like that, some rhetoric like that coming out would be positive. Oil would probably come in a bit, right? Assets, risk on assets may be able to catch a bit, right? Maybe the more beat down assets as well, ones that are where their price to earnings multiples have compressed a bit, right? The companies become more rich in the sense that it's more rich in its true value and it comes at a discount. That the names of those assets may do super well over the next within that backdrop, right? This is all hypothetical. I'm trying to do a play-by-play before it happens so that when it does happen, when I do start to see those things come into fruition, I already have that in my head to be able to go through it all, right? And that also goes to another point of view that I've really started to dig deeper and deeper on over the past 2-3 months myself, is the philosophy of invest first, investigate later. Philosophy brought up from George Soros and doubled down on Stan Druckenmiller. Like, these guys have been able to build out several models in their head of what could happen, what happens then. Like, when you look back on George Soros's trade on shorting the sterling pound back in the early 90s, when I think post World War, no, when was that time period? I'm forgetting right now. Post war, it was not early 90s then. I gotta close the loop on that time reference. My fault. But essentially, at that moment, the British government was working together more closely with Germany, and their dollar was very strong, and the German economy was also rather strong. And then the British economy was not doing so well, and in a way, it kind of married with the German economy to try to help itself get larger and bigger, more robust. But in doing such, it ended up devaluing the British pound. And his ability to understand that beforehand allowed him to lean into the trade heavy, and it was something that was able to bring in $1 billion on profit the following Monday morning. Because he already built out the model beforehand. It was able to push the button ready. So in this backdrop, I'm looking to see what can change. Maybe monetary policy comes out, right? Maybe the new Fed president. I'm not sure exactly when he gets put into office per se, but maybe when he gets put in, he comes in a real aggressive, and he's able to convince the rest of the presidents that we need to drop by like 1.5% on rates, which would be very aggressive. And what does that do for the backdrop? That generally means risk on assets fly, safe haven assets come in, commodities also will tend to fly a little bit because now inflation starts to become a question mark, because we have less. We have a little bit less strict financial conditions, and now conditions get a little more loose, right? And you get to start to see the gauge of like, oh, things get a little loose, people get a little money, you know what I mean? You know, money, they get to keep, you get stack up, all that. So those are all things that we have to try to think about. And that's also how I was able to kind of build out my American Airlines short that I'm in at the moment. Um, and I'm gonna keep it a buck with you. If you haven't seen my reel on Instagram, which was I believe maybe not the last one I posted since today, but the post before that, which I think was Friday afternoon, it was essentially this. The thesis was super simple. I already know airlines are in a way considered to be one of the worst businesses in the world. They're very capital intensive. These planes are expensive. Labor is expensive. Pilots get paid beautifully. Okay, beautifully. Some of these pilots are raking in. Some of these pilots are raking in comps like that surpass engineers. You know what I mean? Like engineers making like $250,000 a year, bro. Pilots are making 600K. Like, you know what I mean? So they have these expensive aircrafts that they have to maintain and purchase and lease. They have crazy labor costs. They have the fact that their expenses are inelastic because their number one expenses, guess what? Jet fuel and plane maintenance. And not only that, but the way that their business is structured, they have pre-booked revenues that have to outpace current expenses. So if a flight that was booked 2 months ago was priced at the price as to what they thought the price would be for the pilot, for the for the for the fuel at that time, for the not only that, but for the labor that they're going through, right? For the flight attendants, other bits and pieces, different fees that they have to pay for the airport to get their gates, right? Some of these costs are more fixed, but when your number one expense, which is jet fuel, goes up and rips 40% in your face over the next 2 weeks, that flight I booked last month for Bora Bora, that cost me maybe $1,100. If I booked that same flight today or back then with them knowing that oil would be up, what? What is it actually? From like last month. Okay, cool. That oil will be up 80% from now. That flight would not be $1,100. That flight may be somewhere closer to $2,000, right? And now they're taking that loss immediately. And then they take that loss. Now what happens? The trickle down effect. The revenues that they expected are still that. But guess what? Their expenses become unexpected. The expenses become, in a way, unbudgetable because it's not what they planned for. They may have put in a price, range of 20, 25% just to help them out. But I don't think their revenue managers were pricing in an 80% increase in oil. Excuse me. That has led to easily, on Friday, jet fuel prices were at 100% from where they were the week prior. So you got oil right now at 8:45 p.m. on Sunday night, 20% higher. I can imagine jet fuel prices are at least 150% up from where they were last week. Now their earnings expectations, guess what? They have to get re-rated because their plan, their revenues were effectively the same, right? On what was already booked. But then guess what? They had to also adjust prices for the newer flights, right? Me booking right now is now deterring me. So now my demand as a customer is deterred from buying the flight now because my flight to Bora Bora is $2,000. Last month I saw it was $1,000. I'm not gonna fly right now. Maybe I'm not gonna take that flight right now. Maybe I'll say, you know what, let's check again at the end of the summer. or maybe even fall, right? So now the demand becomes elastic because I'm not that interested in going to borrow for $2,000, especially when I saw it at 1100 last month. These are the types of things that to, in my opinion at least, some people may think that all this doesn't matter, and that's great for them. Some people are able to print in the markets without having this mindset or without being able to view things in this manner, and that's also great for them. And that's the beauty of the markets. There's a billion ways to print in this market, and it's really just about finding what makes sense for you. And at least so far as of right now, this will make sense for me. You know, choose. So all these things are what I'm thinking about, right? I'm seeing reports that, hey, New York Times is saying, and other sources are saying the White House officials expect Trump to announce a victory over Iran and try to bring an end to the conflict due to the disaster that's unfolding in the markets. This is very important to know. Why? Because this could lead to the Trump administration to change the current trajectory. The pendulum may swing. It may go from extreme oil prices, risk on assets extremely sold off, to, oh, maybe not so much sold off. From willingness to disrupt, right? I think just Thursday, a headline, or Friday, he said, if oil rises, it rises. So be it. Kind of energy, right? Like what? What does that mean for us? What does that mean for your precious CPI inflation print that you want to go and compare back to Biden or previous administrations that inflation's down, even though that data's skewed? But don't get me hot on that, because when this oil prices come in for these readings, core CPI is going to get adjusted. Inflation gets adjusted. People's perspective on the markets, investors in the markets, are going to pull back. Right? Mm-hmm. You're busting. For real. You stole my fork? Yeah. Okay. Thanks. So it's also kind of why I watch data so much. I watch sentiment data. I want to know what these guys are thinking. I want to know why they're thinking that. Right? Where's my research? Oh, here we go. So I'm seeing market exposure shows that the CTAs, the commercial hedgers, pulling back in long exposure. Right? It's the first time in a little while we've seen this much of a dip on the risk parity bond. It got pushed into extremes, and now it's mechanically deleveraging. So it's going to probably lead to a little bit of bleeding. Right? Bonds as well. CTA trends show a net short. They're now short on that. The SOFR signal. So SOFR is a way of gauging credit risk, especially more corporate credit risk. And corporate credit risk effectively helps us understand, where they are willing to continually push. Right? There's so many push and pulls in this market. We've seen private credit have some stumbles as of late. That's another thing that's also in the backdrop. The labor market's pretty weak right now. That's another thing in the backdrop. Like there's so many levers of all of this, so much stuff's going on, and your ability to capture all this stuff and kind of compile it, and again put it into a model in your head, or some form of a frame is where you will be able to gain your edge. Because if you can continually see that and put that edge somewhere, you can do it. Right? So this is just some positioning that I put together based off a Deutsche Bank report that I saw. Oil long, obviously, it's a rather high, large conviction at the moment, and it could potentially be at closer to price target levels. And I plan to see myself trimming in the morning to lock in some of these positional gains. Um, these refiners, VLO, PSX, the cracks are spreading. They're spreading upstream to ETFs, and this demand destruction could come through, especially if a recession, yes, I said it, the R word, starts to, show that, pardon me, that it has capabilities of doing such. Are you concerned about Blue Owl and BlackRock? Of course. Yep. Um, I'm not I'm not too concerned about BlackRock, but I'm more concerned about Blue Owl. Um, they've BlackRock has other forms of income that can definitely keep them stable. Like they're super huge, at least for the time being. Maybe credit continues to deteriorate in a crazy way that I'm not putting in my model right now. That does start to show that BlackRock is like under some huge stress. But Blue Owl, as a much smaller private credit firm, I can definitely see some problems come about in that case going forward. But then again, the name's been beaten up pretty bad already, right? So for it to continue to go down, the expectation has to continue to decline, right? It would also need to decline at a rate that, um, right? Yeah, exactly, Darius. Yeah, I was just mentioning about this a little bit earlier in the stream, but yeah, I think we did mention that we put boots on the ground. I think we did this weekend. To be honest with you, I don't know for sure. I don't think I've read a headline that confirms that at least, but I've definitely seen more explosions and more and more. So at least as of right now, it shows that there's like lack of a interest in de-escalating this, as opposed other than what I just mentioned in in the New York Times report, saying that it's possible that Trump's just going to announce a victory and kind of try to ease out of the scenario and say that he did what he had to do and it is done and XYZ. So that's a possibility. But yes, if we do put boots on the ground and we continuously go at this, we're gonna end up putting these whole scenarios out of gate. Domestic investments in the United States, you mean, or you mean like in their own country's investments? Um, but yeah, in the U.S., yeah, for sure. That's all a part of it. External fund flows. Yep, exactly. And that limitation of U.S. investment will be a part of the demise of what we're seeing right now, right? Like, um, got the Russell down 330 basis points. Oil is basically back at 110. Excuse me, Nasdaq down 2% plus. S&P down 1.8. Right? Like, excuse me. Risk on assets have come in dramatically. Metals are not acting like metals; they're acting more like speculative assets. The dollar is up 62 basis points. Um, So yeah, these are all a part of the dynamic, right? So this is also a bit of the alpha matrix that I was mentioning. You know, AI risk casualties, right? So software, IT showing pretty good performers. So like I'm tactically bullish on software at the moment, seeming that they've been so beat down already that their earnings multiples are showing them as cheap, right? And I'm liking IGV for that. We also do have multiple earnings coming in with that. I'm sure airlines, as you guys probably already know, talking about book here at this point, really. Korean equities. I recently exited my position in Korean equities. Um, that was a beautiful, beautiful trade on EWY. EWY or EWJ? Yeah, EWJ is Japan. So EWY is Korea. Yeah, EWY. Exited that position. Um, um, Contended the video can't break the 194 zone. Why? Why are you concerned about that? That it can't go lower the 194? Or you mean it can go above? Let me see. Oh yeah. Set because right now it's at 177, the 194 zone. Yeah, it's possible that it can't go higher right now in this backdrop. Oh, if you got long term holdings, then none of this matters. Gotta start zooming out, man. 5 years from now, we're gonna need more chips. Period. Point blank. You feel me? 5 years from now, we're gonna need more chips. Right? Whether that comes in the case of Nvidia increasing in shareholder value, it be a case, you know. You know, and in that same vein, maybe you want to start doing some dip shopping soon, or setting up a plan for dip shopping before it happens. Right? Like if Nvidia retraces all the way back to 120, are you buying? I might be. Shoot. You feel me? Like you may just want to think of it, flip the scenario on its head. You know what I mean? Try and flip the scenario on its head. I'm long Nvidia from my cost basis at 106.51. If Nvidia pulls back to 120, I'm buying some more. That seems like a pretty good buy to me. It's obviously an exaggeration. I don't know if we're getting 120 or not, but I just threw a number out there. Um, but yeah, as long as you don't need that money in the next 5, 10, 15 years, you're fine. Yep, it could. It definitely could. And then yes, that's where you start to think: is Trump going to be our president in 3 years? Is it probable that we have a Trump 2.0 in 3 years? It's probable. Is it probable that we swing the pendulum to the other side? And that we actually have maybe opposite of Trump, right? Where now other things come into place, right? Like this is a part of the game that I was just talking about, guys, where you just run through the mental model of like, oh, what's next? Okay, what could happen if okay. Well, if that happens, then like for example, if we have an extremely liberal new president, I'm not concerned about Nvidia and growing because of allies. I'm concerned about Nvidia and growing in antitrust, monopoly, because now that side, the more liberal side, is more concerned with antitrust and stopping, you know, companies owning the whole market in XYZ, right? So now I'm concerned about that. There's a different kind of risk to take into account when these types of things flip from one side to the other, or the pendulum begins to move from one side to the other. You feel me? So like NVIDIA will probably still do well, but what will be the new challenges that they go through, right? Um, exactly. I do like the point that you mentioned about allies and partners deciding to make it themselves. For sure. For sure. Like what happens if China does take Taiwan, right? What happens? We don't have TSM, and now TSM stops working in the United States. Like anything's possible in the markets for sure. Um, a lot of it just comes back to how much weight are we willing to put it in the case of probability. How many different things and data points have come in and said that oh, this is what's potentially moving. So here's what I'm seeing as the hidden alpha. Um, that's cool. Okay. Signal one. Back end oil curve is a truth teller. Front end backwardation basically just saying that as right now, the way that the money has been spread out along the curve and the open interest, it shows that a lot of people are pricing this to be solved within the quarter. So a cheaper structural issue conflict, you can buy the back end of the curve in the effect that you know that they don't believe that this will continue unless it does. If it does continue, then it definitely allows for something that we end up in unprecedented land. Um, the real rates that we saw when war broke was that the growth scare is more important than what could potentially happen in inflation, and yields rose in AI and tech, and the Fed has more room to cut. So in reality, there's a monetary policy adjustment that could come in and disrupt this negative story that we have and turn it from the negative story into what is the positive story, right? Like maybe in this world, maybe Trump is trying to use this as a way of justifying as to why he believes rates should be lower, right? He came in the office talking about we want rates lower. He's ready to bully Powell and give everybody issues and all this other stuff. Um, and all in all, he ends up creating this backdrop that forces the hand of the independent Fed, right? And it's not as easy or as blatantly in your face of like, okay, Powell, drop the rates now. You should listen to me. I'm smarter than you. But more of a, I'm gonna do all these external things. I'm gonna do this. I'm gonna have this. I'm gonna do this, and it's gonna be for different reasons. But at the end of it all, when it comes all the way down to the bottom, guess what? It gives me exactly what I want. Rates lower than where they currently are. And in the meantime, you were able to maybe solve some other things that were of pertinence to you in your administration, right? Like, I guess, getting Venezuela's oil or supporting Israel in this case, right? Those things were important to your administration. So you're now able to end up being a win-win scenario because of it. You know? So yeah. Um Gasoline's gonna outperform even Brent. The cracks may spread. Try and look into refineries, right? I think that they may do well, but I do think that there may be an opportunity where they're not as crowded as energy ETFs. So there may be some area to catch up on in the gap, and that could present some opportunities there. Another thing that's a bullish signal in this case. You have an estimated 14 billion in U.S. outflows in the tax season, right? So that shows that institutions are selling, but tax refunds should be driving most of retail's buying, right? And the outflows signal that institutional redemption is the main reason, and that has led to an overwhelming seasonal retail bid. And to be fair, retail usually has the paper hand. You know, retail is usually the one that's ready to buy at 100 and scared to hold at 95. So another thing. Another thing too that I noticed. There's been a huge focus on food related assets. I saw what was this? Let me find it. So I said something's happening in food a few days ago. They're sweeping Vital, the eggs company, and then like it's nobody's business. And then they come back and then they're sweeping SYY for year end. The major food distributor in the US. And it's a rather meaningful sweep to me, if you ask me. Like 300 grand, that's a pretty large sweep. In an option that has low to. Are you guys seeing this? Okay, cool. A low to no open interest. Like, who cares about Cisco right now? Right? Like, and then if I keep going into what other flows and like buys I'm seeing, they're buying wheat futures ETFs. Oh, another quick thing. Financial conditions, right? Financial conditions went from, pretty soft and easy for the most part. That's why every single dip got bought last year, into now a light yellow, even a light red, even in some cases. So something to think about. But and wheat, look at them sweeping March wheat 23 with good size. This is about 250K right here. That position. Wheat. Okay. Corn. Corn? ETFs? These guys are coming in with an August expiry at 20, 19, 24. So okay, a little more a little less aggressive in the strike price, but a lot of open interest sits in the 20 spot. Right? So something's happening in food. And then I sit back and well, I remember what happened last war. Fertilizer. The Ukraine Russia war back in 2022. That was a part of this hyperinflation cycle in 2022. Ukraine's one of the largest producers of fertilizer. I remember I was working at a country club at the time, and I had to help try to talk our groundsmen a bit back from ordering more fertilizer because it was at such an extremely elevated price. I'm like, yo, we don't need more fertilizer, especially when we're going to do a whole redo of the lawns soon. Like at this point, you might as well just stay back, use less fertilizer, right, and just let it do run its course. Especially these elevated prices. So as fertilizer now comes in question, it seems like food is starting to come in question, and the ability to produce food at the price rate that was prior and at the clip that also was prior. So people are interested in going long food. Talk about nth order effects. Companies like Dow Chemicals, they create chemicals and fertilizers, right? They've done pretty well as of the last few week or so as well. You see what I'm saying? Like when these events happen, it's okay to look at the first order of events. Yeah, they're hitting the oil fields. It makes sense. Okay, oil goes up, boom, boom. That's the first one, right? And if you're not in that trade in a timely order, you've missed the ship. But then also, if you're not able to double back and start to think deeper into what happens next? What's the second degree, third degree, fourth degree, fifth degree? What happens next? Next, what could potentially? It becomes way harder for you to find trades in these environments. So I would implore you to start to try to map out these nth order effects. What happens next? How would that affect this? Cause and effect here, cause and effect there, such and such. And try to think about those things. And also, all while doing that, find pockets of the market that are literally, quite literally, not really affected by what's going on. One of them being what's happening in Circle. What's happening with Circle? The stablecoin, there's been a whole back and forth with banks and the big, beautiful bill and Brian Armstrong of Coinbase and all sort of stuff. And then there's more intention towards stable coins. I hear that the state of Florida is doing something with stable coins, I believe, with the taxes, and they'll be able to remit taxes via stable coins, right? So the adoption started to come along a bit. Then I started looking into the data and I say, well, the strike, the 140 strike, as of February 23rd, had an open interest of 2,226. And then by this Friday, the 140 strike has an open interest of 4,750, a 109% increase in open interest over the last 2 weeks. What does that tell me? There's a growing interest in this name potentially being at towards $140 within the upcoming 12 days, when it's currently being priced at $101. Opportunity, ding, 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 opportunity, ding, ding, ding. Look here, check this out. What's happening over here? This interests me, right? Those are all mechanisms of the market, pieces of the market that I continuously watch to try and see what the heck's going on over here. So, if you have any questions, um, I guess let's take a look at futures a little bit longer. Um, Semis may not do too well. I think EWY is down. Ooh, sheesh. SMH down 3.56% to 367. 367. I grabbed a 380 put on Friday, 30 minutes before close, as well as a Soxo put, SOXO, on Friday, roughly 3:30 before market close. You know, it's all part of really like what's going on. I don't know what else to say. Not much else to say. I'll kind of leave it at that. I mean, maybe we get a bit up before the market opens actually tomorrow in about 12 hours. But at least as of right now, things not looking too great. So I probably just won't open my long term portfolio and would rather just look at my trading portfolio. Um, Soxel, the 3x leverage down 11.3%. Huge. Literally huge. WTI, 19% to the upside. That's what we're seeing right now. Sheesh. Um, Circle is down. Circle is actually down 4.8%. So now the contagion spread. Before, Circle was still performing well, even during all the bombings and question marks. Right? So now that pocket, it's not looking too safe right now. Because what was let's see IGV. IGV is down pretty aggressive as well. Dang. Okay. The contagion has officially spread. It is now a market wide scenario. Pockets of the market that were doing pretty well, kind of holding, even though turmoil and stuff was breaking out, not really doing too hot. And IGV was one of them, as well as Circle, one of them, and they're both down pretty aggressively. What's this up and down market? It's volatility. Yeah, we're down. We're down. We're at war essentially. Risk on assets go down during war. London Bridges 2217. That's effective. What's going on? Yep, we're down. When the risk on assets, listen, risk on assets, NASDAQ, S&P, Russell 2000, Dow, Bitcoin, all these other pieces, they don't like uncertainty. They don't like it. They want to see that there's a clear path to growth, to upside, to possibilities, to future, to adaptation, to innovation, to all the things that they want. And this is not that. This is a blockage of that, right? Because the flow of capital will reverse. The flow of capital will go from being aggressive to, well, maybe bonds look nice, or maybe cash looks nice. I'm going to sell my risk assets because I don't know what's going on right now, right? This is a headline driven economy or headline driven market per se, run by Orange Man, you know? So, in a way, we don't really know what's going to happen. He could say this and then taco 20 minutes later. And kind of because of that, a lot of it's going down. Um, so that's why I look at data, because at the end of it all, the data itself is what's actually moving the markets, the buyers, the sellers, the inflows, the outflows. And then secondly, the data could tell me before emotions can, right? All these gets expressed via emotions. And right now, oil up, dollar up, risk assets down, metals down. Which one is the black sheep in this scenario? Metals being down. Metals usually act as a safe haven and they tend to be a positive in these type of events. But based on the recent backdrop in metals, with gold at 5,000 an ounce and silver somewhere closer to $80, it hasn't seemed to act that way. It seems to act a little bit more risky, a little bit more on the risk side of risk assets. So, I mean, I think that's pretty much it for me. I don't have much more to really go off of. I just really wanted to harp on the concept of taking what's directly in front of you and not taking it as, well, that's it, but to take it as an opportunity to look what is further beyond that, right? What can potentially develop beyond that? Um, and that, and how does one thing potentially interact with this to potentially adjust this, to potentially move this? Yeah, let's manage the market this week. Let's see what we got. Um, hopefully, you guys have a great one. Happy printing. Aging out. Exactly. Gold's down. Gold's down. Gold's acting weird. And it's really mostly because the dollar's up. When dollar's up, assets, gold assets and metals assets don't usually like to go down. I mean, don't usually like to go up as well with dollar. Because they kind of act as a an indirect relation in a way. That's the right word, right? Indirect, yeah. Where they converge. But yeah, that's pretty much it for me. Peace. Aging out, y'all. Where's the end button? No, wait. I low key can't find it. They moved it. Oh, oh, it's over here. I found it. Okay.